what Principal Finisterre does that's quite different from how many of our peers manage EM debt is that rather than thinking about our investment universe alongside the traditional asset class lines, sovereign debt, corporate debt, local currency debt, we're actually rejigging that into different types of assets which are generating different types of performance for the portfolio. So we segregate our investment universe in terms of income assets, beta sensitive assets, which add some capital gain to the income stream through market timing, alpha generating assets or strategies which are more uncorrelated, to be enacted at times where we don't have a strong view about market direction. And finally, we also assume that there are a number of EMD assets which are so defensive that they're almost as good as cash in the middle of a crisis. And so what we're doing is that we're riding the cycle in trying to enact this or that performance engine in the portfolio. And essentially, we think it's a winning formula just because there is a cycle out there that you need to ride. And so at different times in the cycle, it's easy to understand that your portfolio, in theory, should be structured differently, which is not the case for most ETFs or benchmarked funds, which are always structurally similar across the full market cycle. Right. So clearly we're in a fairly turbulent global environment, right? So the policy change in the US, its impact on the US economy, on US treasuries, on global risk appetite has to be factored in. Yet we're thinking that perhaps a number of risks which seem obvious to people may be a bit overrated. To be sure, starting with this tariffs issue, it feels to us that the bulk of the countries which do matter from an EM debt investor are perhaps not as exposed to those risks. If you think about it, the tariff issue mostly affects Southeast Asian economies and China. And from an EM debt investor standpoint, those are countries which these days tend to be relatively low yielding, relatively unattractive on the credit side. So we're talking about tightly valued investment grade credits in Asia. So in a nutshell for us, Asia is a low yield, low VaR, low volatility region, which we don't necessarily depend on to perform. At the end of the day, the net impact of tariffs should be slightly growth negative, but less so for EMs than for the rest of the world, surprisingly, but also more deflationary. So if that's the case, then there's a way for us to even monetize that, although on the tin it's a negative narrative. But for example, by being long duration in those Asian countries which continue to cut interest rates, that's a way to benefit from that. And so people sometimes wrongly think that a negative narrative may not necessarily lead to positive performance. That's not the case for EM. The last point is that inflation is no longer an issue anywhere. And against that, local yields are just amazing. They're still near 20 years highs. So these are powerful nuances that people need to understand. Now, in terms of true risks, though, we're still acutely focused in a slowing growth environment on fiscal risks. Yet, monetary policy saves the day. So where fiscal policy may be constrained and may create some tensions in some countries, because let's face it, Brazil, Colombia, Mexico are facing hurdles on the fiscal side. So that's going to be our key point of focus going forward. But against that, a weaker US dollar environment, very high starting yields in those countries allow central banks to cut without fearing currency weakness. So that gives them a lot of flexibility. So we would mitigate those risks a little bit. So the strongest conviction we have these days is that we're at the very start of a global asset reallocation move away from the US, which will play out over many months. Large global investors have not even started relocating their assets away from the US. I mean, to be sure, it won't be a stampede out of US assets. They will remain a key part of global portfolios. the starting point is so extreme in terms of both positioning and valuations that it's only logical to imagine that some downgrading of those exposures should benefit in turn to the rest of the world. And in that respect, EMD stands out. It's perhaps the most underowned of global liquid asset classes. We've never seen the return of flows into EM fixed income post-COVID, perhaps because private debt was acting as such a magnet and we were simply ignored. So we're still struggling to understand that. But the truth is that these days, very few people at the global level own any exposure, or they own minimal exposure to EM debt. So for us, it's not difficult. Even a slight reallocation away from US assets, even a slight redirection of flows to EM debt could have a magnifying impact. And for all the reasons I developed before about the positive backdrop in terms of policy flexibility, in terms of only mild growth slowdown, we think it's a very asymmetric asset class for a global asset allocator, which will give them maximum diversification away from the US economy.